Welcome, everyone. People streaming in still as I speak. Welcome to those people who've just joined. Great to see you all. So this is the second session of our ISA Millionaire Mastery. And clearly, when we say mastery, ladies and gentlemen, we mean mastery of the material, not mastery of the market. That would be arrogant, to say the least. I always look upon myself as a lifetime student of the market. So I'm running a little bit late. Last week I went on a long time, and quite a few people emailed me to say that they had to get back to work. So I'll do my best not to run on as long today. However, I do suspect I'm going to need another session. So it's supposed to be 3 mastery sessions, but I shall do my best to get another one online. I haven't got a date for it yet, but I'll let you know next Tuesday afternoon when that's going to be. And I'll get VectorVest to send everybody an email about that. So I think I'll probably have to put on an extra session. I hope that's okay with everyone. Again, the first thing that I have to do, folks, and many of you, pretty much all of you have seen it a dozen times before, is the FCA disclaimer. We're authorized by the FCA, the regulator, and although I'm qualified to give financial advice, I can't do so because I haven't sat down with you and done a long and a detailed fact find. I'm allowed to talk about stocks that I own myself, but I have to make it very clear that although those stocks are suitable for me, they may not be suitable for you. So that said, we can move on, and we can move on to much more interesting matters. And I now need to catch up to what I hoped I was going to do last Monday, or last Tuesday, should I say, but didn't get time to do. So I'm playing a catch-up game already, and it's only the second week. Get rid of my emails so that I can't get that up already. As you can see, the S&P 500 sitting at that same level that it's been for the last 3 weeks now. That's a 4-hour chart, and still sitting at that 4,110 level, give or take a tick or two, 4122, and it's been there since the 3rd of April, and that's been quite a difficult period, that's for sure. Although I did make a bit of money intraday yesterday, so I can't complain. Tony, to find the recordings, you just go to VectorVest. Go to the VectorVest University, and then you actually just scroll down until you find the course, and click on them. They're all there. So if I click on the VectorVest University, and it's going to show all the courses that I've done over the years. Some of the ones that I haven't done, but all of these, and then you go right down here, and I've got so many of them. There's how to become an ISA millionaire, and if you click on that, you can start it or continue it. So I hope that helps, Tony. All right, so I hope that helps. And all the recordings, this recording will be on there in 3 or 4 hours' time, I hope. I'd send it across to the US, and they put it on the site pretty promptly. So it'll be on by later on this evening, that's for sure. So if I go to, and I have to get rid of that for a second, and I had these all open, but I go to, as I say, I had these open a second ago, I don't know where they went to. And this is where I got to last week. And I promised you a little bit of trading psychology along the way. And there's 3 things that we need to make some money. 1, we need a methodology, and that methodology has to have the characteristic that it must make more money when it's right than it loses when it's wrong. And for 2/3 plus of the presentation today, I'll be working on a methodology, so chill. I'm not going to bypass that. I know people want to get stuck in to the charts and to the analysis straight away. The second thing you need to do is to manage your money very well, and last week I suggested that if you just do something as simple as dividing your money up into 10 bits, and then making sure that you never lose any more than 10% of one of the bits, that will take care of that for you. And we went through a little calculation that I've done maybe 1,000 times in these forums, that will calculate the number of shares that you can buy. So if the position falls apart on you, based on the VectorVest stop loss, that you'll have lost 1% of your capital. Okay, and then the third thing is just playing the game over and over and over and over again. And I find that many people including very experienced traders and investors, will spend 99% of their time trying to optimize the edge, but 1% of their time, or even less, working on how to play the game. And how to play the game is without a doubt 99% of the exercise. And people spend no time on it at all. In fact, I note that Tom Hogarth is speaking, my friend Tom Hogarth is speaking on Friday at the IX show, and that's what he's going to be speaking about at the IX show, how we need to spend more time working on ourselves to learn how to play the game than working on analysis. I've seen this in my asset management business in Cape Town, where I had highly qualified people who couldn't have traded their way out of a wet paper bag. You know, they knew everything about markets, but they still couldn't make any money. And I think I told you the story last week of how the guy who came in to service the cars got interested in markets, and he was making more money at the end after about a year than all the CFAs and PhDs in economics put together. And the same guy who used to service our cars now works for a hedge fund in Connecticut, Greenlight Capital in Connecticut. So learning how to play the game is incredibly important. So I'm going to try and talk about that briefly now. So don't fall asleep on me, please. So last week I spoke about clusters of good and bad luck. And in a 50% system, and certainly in the market that we've seen over the last 3 weeks, if you could call it 50% of the time correctly, you were doing well. So all markets move. Sometimes they're very predictable and they just keep on going. And sometimes they're completely and utterly random, as has been the case for the last couple of weeks, 3 weeks at least. Nobody knows what's going to happen next, folks. And again, I'll go back to my friend Tom Hogarth. He's made quite a name for himself recently. I first met him when he came to do my peak performance trading seminar at Nedbank, which was a subsidiary of what used to be London-listed Old Mutual. And he came all the way to Johannesburg to do that seminar. It was a 3-day seminar. And I can remember looking at him straight in the eye, because at that stage he believed he was the best analyst in the world. I said to him that the amount that we can believe that we can predict the future on any one trade, that'll be directly proportional to the extent that we fail as a trader. Because the expectation that we know what's going to happen next is the source of all trading pain. It's the source of many, many trading errors, such as hesitation. So how can this be? Well, I've noted this so many times, folks, that many people who start to trade, who know nothing about markets, they do very well. And my brother is a case in point. He was a detective chief inspector in the Metropolitan Police, a very nasty copper. He's the sort of copper that if he knew you for 30 years and you had a bold tire, he would nick you straight away. He knew nothing about markets whatsoever, apart from, he said, in his time in the fraud squad, he'd nicked a few stockbrokers, but knew absolutely nothing about the ins and outs of markets. And he started to do exceptionally well. In the beginning, he had no expectation of being able to predict the market, as he knew nothing and he had no experience. Now, I noted this transition in him. After a few months, he started to read the books that I'd recommended. He started slowly to become a guru. And he now felt confident to predict the market on a trade-by-trade basis. And slowly but surely, the pain starts. And he found that trading errors of hesitation and picking trades start to surface. Now, why should this be? Well, it took me a lifetime to work out why this should happen. I firmly believe that the source of all trading pain is caused by the thought that we know what's going to happen next. And when it doesn't happen, we get a wave of pain from the universe, and it sits in your stomach like 3 pints of Guinness at lunchtime. Now, that pain, has anybody experienced that pain? Has anybody not experienced that pain? You were sure the market was going to go your way. You did all your research. You put your money online. You maybe bet too much because, well, if you're sure the market's going to move your way, why not have a big punt? So when the outcome is poor in relation to our expectation of wave of pain arise from somewhere mystical. And that pain burns and builds up until you have a burnout. Getting rid of the pain and being able to play the game over and over and over again without experiencing that pain of one bad trade, two bad trades, is what the game is all about. And it's the most important thing that I can actually get across to you in this course, and it takes constant work. It really does. So our minds have got two design characteristics. And Ben told me how to find the thingy last month, I think, or last week. Yeah, here we go. So we associate one moment with a previous moment. Now, that means, folks, that if you were a youngster and you put your hand on a hot plate when you were a few years old, you felt the pain of the burn. Now, for the rest of your days, your mind has been hardwired to avoid physical and emotional pain. And for the rest of your days, when your hand comes close to something that's hot, you relive that moment and you pull your hand away. And this is how we learn. Okay? You have a crash. Every time you actually come to a similar circumstance in the road in front of you, you relive that moment and you're extra careful. This is how we're hardwired by the Creator to actually learn from our mistakes. Now that works really, really, really well in life, but it doesn't work that well in the trading environment, where strings of bad ones, and even in any business environment, where you have setbacks. So let's say that we've got a really good trading plan. And if you follow my rules, if you follow the Vector Vest prescription, I think you should be able to get it right 66% of the time. Not always. Sometimes the markets will go into a miserable period where the good Lord himself couldn't predict what's going to happen next. But frequently, you'll start to get a nice trend in the market. Fundamentals are good. The overall market is rising. The share is breaking up through new highs. And you can predict the future where you make twice as much as you have to risk 66% of the time. So what we're saying is that we're going to buy a share at 10. We're going to put a stop loss at 9. And we want to make a target of 12. That's 2 to 1 when I was at school. I admit it is a hell of a long time ago. And we want to be able to get that right 66% of the time. That's doable. Would you agree? Maybe not in this market, but it's normally doable. So the expectancy in 3 trades, when you're right, you're going to make 2 times 2. When you're wrong, you're going to lose 1 times 1. So you're going to make what? 4 minus 1. You're going to make over $1 per pound, $1.33 per dollar risked. It's difficult at the moment, that's for sure. We're probably down to 50% at the moment, Tony and Jeff. Way back in 2020, we were up at 90%. They just kept on going. At least 90%. I can't remember having a bad one. Now, our job is to take each trade without fear or hesitation. But if you remember last week, I said that if you're right 66% of the time, well, the probability of a bad one is 1/3. The probability of 2 bad ones is 1/9. The probability of 3 bad ones in a row is 1/27. So sooner or later, you're going to hit a run of 2 bad ones, maybe 3 bad ones, easily. If you've got 1 good one, 1 bad one, the game would be much easier, but it's not like that. So let's say the first trade's a winner and the second trade's a winner, but sooner or later a bad trade must come along. If we believe that we know what's going to happen next, and for most traders, this is why they put the trader in the first place, then the loser is accompanied by that big dollop of pain that comes in from the universe. An awful lot more people here than when I welcomed people earlier on, guys. So welcome along. I'm doing the trading psychology bit that I should have done last week because I ran out of time last week. Now, our brains are wired at a very deep level to associate one moment with the previous moment and to avoid emotional and physical pain. So, folks, at a level that you knew nothing about, you start to self-sabotage, not to take the trade. Hesitate. We need another course. So, folks, if you want to get, I know we sell courses, but if you want to get yourself off the course merry-go-round, you really need to internalize this, because I assure you that nobody knows what's going to happen next. Nobody. Now, there is a bloke in Australia who says he does know what's going to happen next, and he charges you $25,000 for the long-lost secrets of W.D. Gann. Now, W.D. Gann's a great guy. I have a lot of respect for him, but he'd be the first person to say that markets are probabilistically based. He would really be the first person to say that. So nobody knows what's going to happen next. And once you believe with every molecule of your being that the market cannot be predicted at the level of one trade, it's impossible for you to feel pain. If you do feel pain when you have a losing trade, it's because you thought you knew what was going to happen next. The market can be predicted. So let me just rephrase that. Does technical analysis, does fundamental analysis predict the future? What do you think? Does technical analysis and or fundamental analysis predict the future? Well, I think Jeff has got it. It depends on the batch size, folks. But at the level of one trade, nobody has a clue what's going to happen next. But at the level of 20 or 30 trades, technical analysis and fundamental analysis predict the future very well. And the analogy that I give on this is the analogy of the craps table or backgammon. The 7, if you throw 2 dice down the table, the 7 comes up 1 on 6 dice rolls. The 2 comes up 1 on 36 dice rolls. And the 12 comes up 1 on 36 dice rolls. So if you throw the dice down the table once, there is randomness. But if you chuck the dice down the table 200 times, there is perfect order. And that's the edge that the casino uses to take your money. Because when the 7 comes up, and it comes up more often than anything else, you have a concept called the croupier will shout 7 out and take all the money off the table. There is a way around that, but even the way around that, the casino's got an edge. The actuaries who work for life insurance companies, is one life predictable? No, because it doesn't matter how healthy you are, you get hit by a number 27 bus this afternoon. But if you find a group of people around the one edge and you've got a big enough sample, you can predict how long they're going to live to a few weeks, I believe. Never done the calculation myself, but this is what the actuaries at life insurance companies do. And I don't care what city in the world you're in, the biggest buildings are owned by the life insurance companies. So they build their edge, their profitability on their ability to predict how long people are going to live in a huge sample of many hundreds of thousands. But one life is totally unpredictable. Now, I know for many of you, this is quite difficult to take because you felt that the only way to make money in markets was to know exactly what was going to happen next. Nothing could be further from the truth. The more that you think that you know what's going to happen next, that will be directly proportional to your failure as a trader. I had a guy come to see me not so long ago who was an expert in Wyckoff analysis, and I love Wyckoff myself. But he was the most arrogant so-and-so I've met in a very, very long time. And he was losing money hand over fist, and I could see exactly why. He just wouldn't admit he was wrong in any one position until he blew the whole account. So I suggested to him, he had a CFA, and I suggested to him that his analysis was exceptionally good. And based on a sample of 20 or 30 trades, he would have made a great deal of money, but his analysis had no predictive value at the level of one trade, which is common to all our analysis. So I suggested to him that he get a job. Go into the city, get a job as an analyst. He could then make good money. And if he was capable of thinking in probabilities, then he could start to trade his own account. But at the moment, he hasn't made that yet. He still hasn't lost enough money to realize that he doesn't know what's going to happen next on a trade-by-trade basis. For many people, they have to lose a great deal of money. I may have told you the story about one guy in Cape Town. He came to me. He ran a family office, and exceptionally wealthy family of many, many generations. And they'd given him $10 million US to manage. An arrogant sod. He'd spent a heap on courses. He thought my stuff was rubbish because I was going through this material. He'd spent a heap on courses, not just from me, but from people all over the world. He felt he was an expert in Elliott Wave, which I have no problems with, as long as it's applied to a sample of trades, not just one. He told me at the end of my course that I was a Timex watch in a digital era. That's what he told me. Within 3 months, he lost the whole $10 million. Every last penny of it. Taking speculative bets, hugely leveraged speculative bets on the futures market. Most people have got to lose an absolute fortune before they realize that nobody knows what's going to happen next. You only need one idiot in the market to totally stuff your position. And I realize that over the last few minutes now, I've become quite dogmatic in what I've said, and I may have raised my voice a little bit. I'm only doing that, folks, to try and get this across. Because if I can get this across, your going is going to be quite easy. You're going to be able to play the game over and over and over and over again. Now, a little bit more, I think I've gone through that. Am I saying that we shouldn't work on our analysis? Of course I'm not. I think that once we realize that at the level of one trade that the market can't be predicted, we can certainly work harder to get a better overall edge, by all means. But we have to realize that at the level of one trade, the market cannot be predicted. At the level of, I think, 30 trades, the market can be predicted exceptionally well by technical or fundamental analysis, or, as you know, the vector-based approach, which puts together the best of both worlds, the best of technicals and the best of fundamentals. So, and I've said here, unfortunately, some of the best analysts are the worst traders imaginable. There was an old fellow in South Africa. He had a PhD in metallurgy like myself, and he was a household name on TV, the way you see some analysts on American TV. He's on South African TV forever. And he was a great, great analyst, but arrogant beyond belief. And he felt that he could predict the future. And he went gloriously bankrupt on a TV trading contest using the Elliott Wave. Now, there's nothing wrong with the Elliott Wave. Absolutely nothing. I use it very simply. 5 waves up, 3 waves back. Then the probability of another advance is high. But on a trade-by-trade basis, no. Now, I've probably put you all to sleep with that. Any questions on that, folks? And then I promise I'll move on. It's very, very close to my heart. And I personally, to keep myself profitable and consistently profitable, I have to think about that all the time. Any questions on that from anybody? That little half-hour rant that I've just done is the most important thing that I can get across in this course, bar nothing. The rest of the stuff you can get anywhere, but that stuff is quite special. And I'm going to add to that next week in terms of how to build presence to be able to stay in the moment. Keep your head when everybody else is losing theirs. Thank you, Tony. Any other comments from anybody in the room? Especially the people that are new. Ross, you're relatively new to this, or at least new to VectorVest. Any comments on that? And it is my own material. It's not VectorVest material. It's my own material. Yes, Carol, it's difficult. It rings home to me as well, and that's why I remind myself of it. And this course does as much for my trading as it will for you guys listening. So let's now go back to something that's going to be much, much better received, where I'll get an awful lot more of communication and to and fro. In terms of you becoming an ISA millionaire, this is much less important than what I've just spoken about. Okay, in my humble opinion. So, method, share selection, and I may get onto that today, but I plan to spend most of next week on share selection. We've already talked last week about market timing, but I'm going to summarize that in the last session. And those of you that came in late, folks, I think I'm probably going to have an extra session that I haven't scheduled yet. I just won't get through this in 3 sessions, and keep them down to an hour each. And last week I was told by quite a few that I'd gone on too long, and they had to go back to work and miss some of it. Yes, Ross, markets don't like arrogance. They don't like arrogance. And I see it all the time. It cost me a heap of money in my asset management company. I had a PhD in economics and I had a CFA, and they were both on huge salaries. And the bloke who was servicing the cars was making more money than they were. One of those little vans, and he would come into the car park and service the cars in the car park. Delightful young fella. Now earning $1 million a year in Connecticut. Did I pronounce that correctly? Connecticut, outside Boston somewhere. 2 hours drive outside Boston. We're going to talk about some of this today, the entry trigger. And I've spoken about this last week. And we've touched on this. We're going to touch on the practicalities of building discipline next week. So let me move on now. And we want to find shares that are growing earnings per share strongly and safely. In the 12 years now that I've been working with VectorVest, I found that on that plot of forecast earnings per share, if this darn thing is moving up from the bottom left to the top right, that is one of the strongest predictors of the share doing what it's supposed to do, i.e. move higher. I think, ladies and gentlemen, that if you were to make sure that you're trading in stocks above my bow tie, where the 21's above the 55 is above the 89, until you're making money, that would be a good idea. Now, there are times where I will take a trade against the trend, but I wish I could stop doing that, to tell you the truth. Sometimes when they come off, it's wonderful. But adding the 21, 55, and 89 to a chart improves the accuracy significantly. Now, the one thing that I would like to point out is that I'm not using the 21, 55, and 89 for an entry. I'm just using that to prove that there's a trend at work. Then I look to finesse an entry. And one of the first entries that I was taught, and I was taught this by a fellow on the floor of the New York Stock Exchange, and this goes right back to my first visit there in 1986. And the story, I apologize if I've told you before, my stockbroker in Johannesburg was a young fellow called Darren Mervis, and Darren's uncle was on the floor of the New York Stock Exchange. Because I knew Darren. He organised with his uncle that I would actually get onto the floor of the New York Stock Exchange. And I sat with them for a couple of days, and I heard them talking about this concept called a knockout bar. And I've used it ever since. It's so simple, and the best trades are always the simple trades. So what's a knockout bar? Well, and we'll show you lots of examples of it now, and then we'll actually try and look for some if we've got time. But a knockout bar is quite simple. We've got a market that's moving up nicely. And I'm not going to draw in the 21 and the 55 and 18. Just assume they're in place. I went through it last week. And then you get a big brute of a down bar. And that will frequently go to the 21. And that's the knockout bar. If the market breaks that level, that's what's called your buy stop. No, it's above that level. You actually want to be buying the stock. And the stop loss can be really tight down below that level. Now, the psychology here is really, really important, because when you see a big down move like that, then it pulls a great deal of bears. It scares an awful lot of people. That's the first thing. A lot of people start to short the stock, believe it or not, and they'll have their stop loss up here. So when the stock breaks that level, all these people have to cover, and the thing starts to motor. Now, we want to apply this to a stock that's growing earnings per share strongly above the bow tie. And your humble correspondent, to quote Ernest Hemingway, lived on that for quite a long time. That one setup. The knockout bar. Let's see if I've got an example of it here. And we're going to talk a lot about exits, because now the pullback, any pullback should occur on falling volume. So you should see in the knockout bar, that knockout bar happening on relatively low volume as it pulls back. So the characteristic of an up market, folks, is prices rising on rising volume and then retracing on falling volume. Rising on rising volume, retracing on falling volume. And I actually illustrated that on TCAP yesterday afternoon, if you remember, if you were in the Q&A yesterday afternoon. And you know, the markets tend to break out on rising volume and pull back on falling volume. And that is, in fact, from Richard Wyckoff's original course in 1930. I just had years ago, I had the artist to put the color on it. So this is Fever Tree. And Fever Tree is a good example of a knockout bar. You see this? There's the 21, there's the 55, there's the 89. At this point in time, Fever Tree was growing strongly, and we get this big brute of a bar back. It then moves up, and it breaks that level. So that was the entry. Falling volume. So you should see in the knockout bar, that knockout bar happening on relatively low volume as it pulls back. So the characteristic of an up market, folks, is prices rising on rising volume and then retracing on falling volume. Rising on rising volume, retracing on falling volume. And I actually illustrated that on TCAP yesterday afternoon, if you remember, if you were in the Q&A yesterday afternoon. And you know, the markets tend to break out on rising volume and pull back on falling volume. And that is, in fact, from Richard Wyckoff's original course in 1930. I just had years ago, I had the artist to put the color on it. So this is Fever Tree. And Fever Tree is a good example of a knockout bar. You see this? There's the 21, there's the 55, there's the 89. At this point in time, Fever Tree was growing strongly, and we get this big brute of a bar back. It then moves up, and it breaks that level. So that was the entry point. That was the stop loss, and it moved up very strongly. So we're looking, and you can digitize this if you wish. There is there's lots and lots of people who've done this, who've digitized this and got a search for it and whatever. Sometimes I despair of those people because, again, they're spending 99% of the time on the analysis and less than 1% on learning how to play the game. I see it all the time. I'm not saying that you shouldn't work on your analysis, not at all. But the number one thing to get right is that nothing predicts the future. So that's a huge knockout bar, breaks that level, and away it goes. And we should do our best to try and stay in as long as the damn thing is above the 21 period moving average. Now we'll talk about adding, taking off half, getting your stop to entry. We'll talk about that next week because that's a section on its own. But that's the knockout bar. Big brute of a bar, much bigger than any of these. And that's just a blow up of the same thing. You see all these relatively small bars and you get this big brute down and it breaks out like so. Knockout bar. That's in the US. There's the bow tie, just there. We get this bar down, breaks that high, away it goes. It's a blow up of the same thing. Logitech, that's a classic example. Can you see how every molecule of your body would have been saying that this thing is going to fall from here? Look at the earnings per share rising. And then it breaks that level and away it goes. Has anybody traded knockout bars? Really good example of it. So that's my first setup, folks. Knockout bars. Tony says he hasn't seen a knockout bar. Yeah, it's so simple, Tony. Big bar like this normally goes back into the 21. And then it breaks that level. There was the entry point. That's your stop. And away it goes. The knockout bar. And by the way, ladies and gentlemen, if you were ever to make the mistake of trying to trade the Forex market, it works perfectly on the Forex market. In fact, it's one of the few setups that does work on the Forex market because it pulls everybody the wrong way, it pulls everybody short. Okay, see how this market, in fact, would have your stomach would have been saying, I want to sell this, I want to short this, or at least I want to get out after this big red bar. Generates an awful lot of liquidity for those people to get in. So this is a classic stop running exercise. And if you do look, you'll probably see that the low of the day has run some important stop levels. Okay, just here. Invariably, that's the case. The market the low of the day will have run lots and lots of stop losses. Julia, it'll work on any time frame, even down to a 5-minute chart, believe it or not. On Forex, it works particularly well on a 4-hour chart. Again, with the trend, 21.55.89. I think you could apply it to an hourly chart, but I know on Forex it works beautifully on a 4-hour chart, where it goes right back, and if you look across, you'll see that it's taken out quite a few important levels. So what happens as it comes back, this creates a great deal of liquidity for the smart money who want to get it. Remember, the definition of smart money is that they don't know what's going to happen next, but their objective is to get in as close to support as possible. Now, if you read my essay last week, you'll see that we've got resistance there, and we've got support here. Came right back, this big bar. Now, if you had cast iron, you know what's, you could have bought it right there. But that knockout bar above the high of the knockout bar, all the people that got out during the sell-off, they now are scrumming to get back in again. And all the people who went short on that big bar, they've got a cover. So you get two types of people buying into the stock at the one time. To cover, you've got to actually buy the stock because you were short of it. And that pushes the thing up. So you've got two types of people scrumming there. That's why it works just so beautifully. I assure you, if something works on Forex, it'll work anywhere. So that's Logitech. Now, that's my first setup, folks. That is the. So what do we want on this? We want the 21, the 55, and the 89. I haven't put it in here, but if I were to draw another window, we want earnings per share to be rising, without a doubt. Now, next week, we're going to look at a great length at watch lists to actually find these. In other words, I'm going to look at by VST. I'm going to look at the Midas Touch watch list. I'm going to look at DEW swingers and a couple of other ones that we can add into the mix to try and find them. Personally, I don't look at much more than the top 30 or 40 by VST, and I don't look at much more than the top 20 or 30 on the DEW swingers uni search, which you should all have in your file. I'm going to talk about that before we finish. So that's the first setup. And I think the more important thing is just look for this thing to run stops. Okay. You can see, if we go back one, you can see how this went right down, and a lot of people would have had stops underneath those lows. You see that just there? A lot of people would have had stops in there and came down the low there, took those stops out, and then all of a sudden it goes sideways for a couple of days, and then it breaks and goes like the clappers. Tremendous setup, the knockout bar. You can live on that alone. I lived on it for a long time, but maybe you would get bored. So that's the first setup. Now, the second setup is the sweet spot. And I wrote about this in my essay last weekend. It's basically resistance becomes support. And I want to see, as you know now, the three want to trade until you're disgustingly profitable. I think all your trades should have the 21, the 55, and the 89 at your back. And you want to be a buyer in here. Now, if you were an institutional trader, you would be coached just to buy the level, just the level itself with no confirmation whatsoever. I don't think you have to be John Wayne. You can wait for a nice positive day there. But on an institutional trading floor, if you waited for confirmation, you'd get a bollocking. You really would. Again, the short side is the same thing as the Irish say, only different. Okay, this support becomes resistance. That's the second setup. I've got some examples. There's the candle. This is a very precious chart to me because that's my very first call in South African TV way back in 1998, I think. And this was a company called Harmony Gold Mine. And I told everybody in advance to buy it there. Okay, just at that level. And the chap says it'll never get back to there. And of course, it ticked its way back to there. And from here, it went the whole way to 120. It went from 19 units to 120. Pure fluke that it went that far. But nevertheless, I made a bit of a name on that. That's all it was. That's the same chart. That's what happened. Went back. Notice the 3 waves back. Always a good sign when you get 3 waves back. And you see here, we got down candles, and then we got dojis and up candles. And if if I were to draw the 89 in there, I've only got the 2 in. 89 was somewhere down around here. So this is Lion Trust Asset Management. And you can see there's the resistance. That's support. You see, this is rising. And these are trades that I took myself. You get this little candle pattern. Now, if you see two candles like this, especially at an important level, that's what the candle people call tweezer bottoms. It's a very, very useful pattern indeed. Okay, so it's largely two hammers in a row, tweezer bottoms, very, very positive pattern, and then away she goes. There's no knockout bars on that chart that I can see. The bodies are, there's no big body right down. But that's a beautiful sweet spot. You should have bought in there. Stop loss underneath that low. That's a sweet spot. Now, that takes a little bit more testicular fortitude than the knockout bar. Knockout bar normally gives you quite a bit of confirmation. The market's moving up strongly. Here you're buying close, but as I say, on an institutional floor, you would be expected to buy the level just there. And if you'd put in your clients at the high of the day as it broke through, you would have got you got a terrible ticking off. You really would. You want to put in your best clients at the low of the day. But I'm not saying you do that. I think you can wait for a day's confirmation quite easily. And that's Avon Rubber. We must have a look at that again. That was a great money maker for me for many years, Avon Rubber. And it's going up in these series. It came back to that level, you can see. And then it came back. There's resistance. And I think that you could sort of give that the benefit of the doubt of a knockout bar just there, but it's a knockout bar plus resistance becoming support. And it's called A Sweet Spot by Richard Wyckoff, way back in his book in 1932. Wyckoff wrote an awful lot of books. Again, you can see earnings per share rising. These people, they sold out all their profitable businesses to go into defense. And they made... I bought a company from 3M in the US that made bulletproof armor for soldiers for the American Army. And unfortunately, the stuff didn't work. So, the share price went through the floor. I must have a look at it again. I haven't looked at it in a while. That's another example of a sweet spot just here. And the best entries, of course, are somewhere around the 21 period moving average. I would have also called that a knockout bar, that big bar down. So frequently you get the same thing. That's resistance becoming support. Cape is no longer with us, as you know, bought out by the majority shareholder. I think that was a terrible shame because that company had a great deal of potential in front of it, and it's gone. It's absolutely gone. So, and that's Sylvania Platinum in better days. So, and lots of examples of sweet spots there. That's Volex. We need to look at that again, and that without a doubt is also a knockout bar. That come right down. Took out all these stops here, and above that high, with any luck, it moved. Now, the last setup before we move to the stochastic is probably the best. It's called the rocket launcher. Alan Lakin, one of our most experienced investors, noted a rocket launcher setup yesterday, in fact, on QQ.L. I thought he was talking about the QQQs for a moment, but I noted, and we'll have a look at that example in a second. But the rocket launcher is no more than a stock that's growing earnings strongly, okay, that gaps through an obvious trend line. Now, the gap can be either right through the trend line, or it can be either side of the trend line. But there should be a gap around an obvious trend line, and the trend line should be obvious. And when it breaks, it goes. It's called the rocket launcher. Now, again, next week we'll be looking at some of my other setups, and that is for those of you that know my work, that's a spring setup, but that's for next week. So there's lots of these setups, folks, and you need one of them to make a living. That's all. I suggest strongly that until you're making money and your portfolio is growing strongly and you feel confident, that you only trade in stocks with the 21s above the 55s above the 89, where earnings per share is growing strongly. At least growing. Okay. So that's Halma, and that's earnings per share. I put in now. I thought I'd forgotten it there, but you got earnings per share rising. Share was pulling back a little bit. I think that trend line's as obvious as anybody could draw it. You know, from there, a couple of touches here, breaks through here, and then you got this gap. And entry point is the open of the next bar. And the stop loss is below the low of the bar prior to the gap, just there. So that's the risk per share there. And of course, that risk per share should never be any more than 1% of your account size. That's the third setup, and I'm going on for the hour now, and I think maybe I'm going to cut it there because we've covered a lot of material. As I say, lots of people said they had to go away. So this is Renew. This is one of my best trades of that era, and I love this little company still. But there is a trend line from there to there to there, pretty obvious, I think. And then we get this gap. Then you open there, stop loss there, and just goes. That's what a rocket launcher is supposed to do. Yeah, it's been a great investment, hasn't it, Tony? Anthony says, can a rocket launcher be horizontal? Yes, it can be, Anthony. I've found myself that inclined trend lines tend to predict the fastest moves, Anthony, but that's an anecdotal observation. But a gap through an obvious trend line, you can certainly live in that. One of our subscribers who lives out in Malta these days, Mark, has digitized that with a VectorVest uni search. And we'll try and get him into our Streetwise meeting for a review of that. He did it some years back. So that's Renew. And again, this is Games Workshop, you little beauty. Now, this is why the earnings per share is just so good. If you see a market going sideways and earnings per share rising within the sideways pattern, and you could easily have drawn a triangle in there, then invariably it breaks and does what it's supposed to do. Now, the entry point there would have been here, stop loss under there, and then you throw the dice. Nobody knows what's going to happen next. Only takes one complete idiot in the world to completely stuff your position. If I've told you this story before, please excuse me. Tom Hogarth and I ran Which Way Today from a lovely penthouse flat in Hampstead. And we were both, on this occasion, I was in fact in Johannesburg and he was in the flat in London. And I put on in the room with 1,000 people watching us, a trade in oil. And the trade went my way. And I was up £5,000 within half an hour. And everybody was happy. I went out to the kitchen, my own kitchen, and brewed up a big pot of Earl Grey. and I was feeling so good. I think I put in an extra tea bag. I threw away that Presbyterian uh, conservatism, and I chucked in an extra tea bag. I was feeling so good, and by the time it had brewed up and I got back to my desk, the £5,000 was gone, and my 2,500 pound stop loss was also gone. Some idiot had blown up a pipeline. We were short oil, price of oil shot up, and I got stopped out. So until you know and can predict some idiot just about to blow up a pipeline somewhere in Nigeria, you don't know what's going to happen next. Okay, that's a true story, by the way. But earnings per share rising. I don't know what was happening. The general market was looking good in those years. The general market was rising with the rocket launcher. I reckon that predicted a move there with about an 80% hit rate, where you could at least make 2-to-1 risk to reward. So when the market is good, it's easy. And I'm more than happy to admit that the market has been difficult. And everybody says that. Even that guy, Mark Minervini, who's won that American share trading contest more times than I've got hairs in my head, he's battling at the minute as well. So markets are not following through. So out of this today, folks, I've spoken about trading psychology, and I've done my best to get it into your heads that markets can be predicted exceptionally well over a batch of trades, but over one trade, it's impossible to work out what's going to happen next. Think of the dice roll probabilities. Think of the actuaries at life insurance companies. I strongly suggest that you build a template on VectorVest, quite easy to do, with 21E, 55E, and 89S that you can overlay on any of your charts. And I strongly suggest, onto you making good money, that you only trade in sync with the bow tie, and you trade in shares where earnings per share is rising nice and smoothly, at least over the last year. The first setup is the knockout bar. Second setup is my sweet spot. Support becoming resistance. And the third setup that I've spoken about today is the rocket launcher, a break and a gap through an obvious trend line. Now, next week, we're going to add to that. We're going to look at the stochastic. Frequently, the stochastic will be saying the same thing as the sweet spot. We'll then be looking at the Wyckoff spring, which is a variation on the sweet spot. It's another test, in fact. And then we'll be spending a lot of time trying to find the location of the very, very best stocks. And unfortunately, a little bit more trading psychology. I'm running behind, ladies and gentlemen, so I'm going to have to structure another session. That'll be a fourth session. But as I say, I've been online now for an hour and 5 minutes. And last week I went on an hour and a half, and that was too long for quite a few people. So I'm going to sign off now. And I just need to make sure that I've answered all your questions. So any questions, folks, before I sign off? Okay, well, that's very kind. Thank you, Anthony and Julie. Okay, folks, we'll see you all. Anybody that's in London, I'll see you on Friday, the 28th at IX. And then our I'll see you guys before the Q&A, because the Q&A is on Wednesday, and I'll see you guys on the same time next week. So that'll be 1:30 next Tuesday, the 2nd. All right. Okay. Yeah. Anybody's coming to the show, please come along and say hello to Eugene and myself. Okay. Oh, Tony, you must wear a suit. That'll if you come without wearing a suit, Tony, I'll be confused. I look forward to seeing you, man. Cheers, everyone. Take care of yourselves. Bye bye.